Hello, I'm Tyler Rudek, Chief Investment Officer at Boyum Wealth Architects. Cash plays an important role in every financial plan. It helps cover emergencies, near-term expenses, home purchases, tuition, and other planned spending. But holding too much cash can create a different kind of risk, the risk that inflation slowly erodes purchasing power over time. This week, I'll walk through a few charts that help explain the role of cash in a portfolio today. The first chart we have is regarding money markets and interest rates. Money market fund assets remain near record highs at about $7.9 trillion, more than double their pre pandemic level. That makes sense in some ways. Higher short term interest rates made cash feel more attractive over the past few years, especially during periods of market volatility. But those rates are not locked in. As short term rates fall, investors holding excess cash face reinvestment risk and may earn less going forward. The next chart we have demonstrates interest income on cash and real returns after inflation is considered. One misconception is that cash is risk-free. While the dollar balance may not move much, its purchasing power can still decline. After adjusting for inflation, cash returns have been negative for much of the past 2 decades. Today, headline inflation is around 4.2%, while 1 month Treasury yield is at around 3.7%. That means real cash yields remain negative in many measures. And last up, we have dividend yields by sector. Stocks and bonds can help portfolios generate both income and long term growth. Certain dividend paying sectors, including real estate, energy, and utilities, currently offer yields above 3%. Bonds may also provide more attractive income than cash. For example, investment grade corporate bonds are yielding around 5.3% on average, while the Bloomberg US Aggregate Bond Index yields about 4.8%. The key is matching the investment to the goal. Cash is useful for near term needs, but long term goals usually require assets that can grow and compound over time. And that is it for this week. The bottom line is that cash is not bad. In fact, it is an important part of a sound financial plan. But holding too much cash for too long can create meaningful trade offs, especially when inflation is elevated and yields are falling. For investors, the goal is to keep enough cash for short term needs while staying appropriately invested in a diversified portfolio designed to support long term financial goals. As always, please reach out if you have any questions, and thank you for watching.